Welcome to This Week in Money. I'm Jim Goddard. Today, we'll take a look at the past week on the major markets. Filling in for Ross Clark, we have Victor Adair from Richter.Interest. Victor tells us after a bit of a correction, stock markets took off again. He also checks into the action on gold, crude, currencies, copper, and cocoa. Editor of the newsletter Rick's Picks, Rick Ackerman, reports in on what the Fed could do with interest rates and gives us some target numbers for gold, silver, oil, and Bitcoin. Rick's concerned inflation could quickly turn around and become destructive deflation. WolfStreet.com's Wolf Richter reports in from San Francisco to comment on interest rates, U.S. consumer, government, and business debt. He also takes a look at auto sales and Canada's housing bubble. We'll talk to Victor Adair right after this.
Recyclico, making lithium-ion last forever. Recyclico's patented recycling process achieves up to 100% recovery of battery metals from lithium-ion batteries for electric vehicles, including cobalt, lithium, nickel, manganese, and aluminum. Recyclico Battery Materials Incorporated trades on the TSX Venture AMY, on the OTCQB AMYZF, and Frankfurt ID4. For more information, visit recyclico.com or phone us at 778-574-4444. Recyclico, making lithium-ion last forever.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
Filling in for Ross Clark today, we have Victor Adair, recently retired from nearly 50 years of being in the brokerage business in BC, but still very, very active in the markets. Check out his website, Victor.Adair.ca. He's speaking to us from beautiful Parksville on Vancouver Island. Welcome back to This Week in Money.
Well, thanks, Jim. And by the way, Ross Clark and I used to work together. It's more than 40 years ago, and we've stayed in touch all that time. I have huge respect for the technical work that Ross does. He sends me the work, and I always read it and take it under advisement. He does a great job.
Victor, how would you describe what happened on the stock markets this week?
Well, there's kind of a common pattern, really, between the stock market, the currency markets, and the interest rate market, and I think maybe this is the key to the week. For the last few months, and it feels like forever, people have been thinking, okay, the Fed looks like they're going to be higher for longer. In other words, keep interest rates high, no cuts coming until, a long time from now, because this darn inflation just is sticky. They can't get it down toward their target. I think the fact that that's how people saw the United States being higher for longer with the rates was the key support for the U.S. dollar outperforming all of the currencies since December. It was probably the arrow in the heart, as it were, of the bond market. The bond prices have traded lower, and the stock market seemed to ignore that until about a month ago. And I should point out, and I know Ross drew this to my attention, that the major stock markets around the world, really, Europe, Japan, North America, had their first down month in April since October of last year. So it's kind of like we got into April and the stock market began to wake up and worry a little bit about, hey, maybe they're not going to cut these rates. So anyway, but this week, that seemed to change. At the beginning of the week, the markets were really still living and dying on that idea. And as the week went by, and it was a blockbuster in terms of the data that came out, macro data, but the data seemed to start out the week indicating, again, inflation staying sticky, the prices of things are going up, the Fed's going to be locked into this, having to keep rates up to try to get inflation down. But by the end of the week, we'd had a total reversal, I think, in sentiment from where we started the week. So stocks were up this week, the bonds were up, and the U.S. dollar was down, all of them. When I talk about the U.S. dollar, I mean the U.S. dollar index against other currencies. All of them a total reversal of going the other way for at least the past month or so.
What's going on with gold?
Well, really simply, the gold market soared to all-time highs. April the 12th was the key day, and people that read my website, and I'm sure some of the folks that are listening see my website from time to time, know I've been talking about Chinese retail buying was really the cherry on top, as it were. And everybody knew about central banks were doing a lot of buying and that, and, there's other bullish reasons for gold. But the Shanghai Futures Exchange just seemed to go wild here, starting about maybe 6 weeks ago. Huge volumes on there and drove prices higher. The premiums on gold for delivery in China were much higher than Europe or North America. The Indian market, which is usually a big demander of gold, they just closed up shop. It seemed like there was nothing but Chinese retail buying driving prices to the high. Well, as often happens, the Shanghai Futures Exchange raised margin requirements for these highly levered speculators, and that was like a stick in the eye, and prices are down about $150 an ounce from those very highs. Now, we're still up a long way from where we were, 6 months ago or whatever it was, but as I say, the cherry on top made here April the 12th, and we're back down about $150.
What's happening on the crude market?
Crude is, I'd say it this way. We hit a 6 month or so high on WTI. When was that? About 2 weeks ago. We've backed up about 10%. And I'd say it's really all about the last 2 weeks. We've had a calming down of what we would call geopolitical stress. In other words, go back 4 weeks ago, it looked like maybe Israel and Iran were going to go head-to-head, and here we go. So I think that contributed a risk premium into the price of crude that got us to the highs. On WTI, I think we got up $88 or thereabouts. And that's kind of quieted down some. Doesn't mean that we don't have problems there anymore. Doesn't mean it can't blow up again. But given how things have calmed down a bit the past 2 weeks, crude oil down about 10% from the highs we had then.
How's the Canadian dollar doing versus the U.S. dollar?
Canada is, this is an old currency trading expression. When you talk about the Canadian dollar, you just say Canada. I should explain that. That's what that's all about. Canada has been less volatile than some of the other currencies. And in a way, for the past year and a half or so, we've traded kind of in a broad range. I'd say, and I'm just going ballpark here, but in December, we hit a multi-month high around 76 cents. We traded down to about 72.5 last week, and we come back maybe to 73 cents here this week. As I've said with you several times when I'm on the This Week in Money show, a lot of the valuation of the Canadian dollar vis-a-vis the U.S. is due to things that happen outside of Canada. It's not so much Canada specific. Usually the Canadian dollar will follow to some degree where the American stock market's going. Or if the euro currency is aggressively bid, for instance, that probably means the Canadian dollar goes higher too. So Canada traded lower for the past 4 months here, but so did, I'd say virtually all the other currencies in the world. So it wasn't just something that, Canada did. So maybe get right to the point. We're about 73 cents here at the end of the week in the Canadian dollar.
What's going on with Dr. Copper?
Copper has had and may still be having an incredible rally. We're up to about 2-year highs, I think, on copper. The price tripled. No, wait a second. No, that's not true. No. A 2-year high in copper. And then the last couple of days here, I think maybe the copper got a little overbought. We backed off about 4% or so on the close on Friday.
Could you still describe cocoa as brown gold?
Cocoa had this spectacular rally, and it began last year, but it just really accelerated to the moon, as it were, this year. But as often happens in markets that race away to the upside like that, it's had a dramatic fall. It's down about 40% in the last 2 weeks. Now, I think I can safely say that I have never, ever traded cocoa. I mean, even going back to the days 40-some years ago when Ross Clark and I used to both work with other guys at Conti Commodity in Vancouver, I just kind of had a thing about, coffee and cocoa and some of those other things were just a little too crazy at times for me when, I sort of specialize in trading currencies and interest rates. Oh, Jimmy, before we go, speaking of currencies, one of the most important events this week, the Japanese yen hit a 34-year low, and the Japanese authorities have been threatening verbally for the past several weeks that the U.S. dollar was getting too high in terms of Japanese yen, and they'd come in and intervene, and the market says, okay, come on, let's show us what you got. Well, they showed what they got this week, and the yen rose 5%. They came in gangbusters and during thin market times and were buyers. Now, one of the things that the interventionists are looking to do is to catch people who are short, and the people who are short start to go, oh my gosh, I'm losing my shirt here, and then they become buyers as well, so that helps the currency rally. So we've seen in the currency markets here, with the U.S. dollar index at about a 6-month high anyway, the positioning in speculators has been at a 5-year high bullish the U.S. dollar. So particularly the currencies that they've been really short are the yen, the Swiss franc, Canadian dollar, the Australian dollar in particular. And I would think if Canada started for some reason trading higher, we could see some of the speculative shorts in Canada come in and cover their positions as well. Jimmy, one last thing I forgot about to mention on crude. The Trans Mountain Pipeline opened this week. That's going to move just short of 1 million barrels a day from Alberta down to the Tidewater the facilities to export from Canada in Vancouver. And that should really help the spread differential between Canadian crudes and WTI. In other words, Canadian crudes usually trade at a discount, sometimes a deep discount to American crudes, because we only had one customer. There's only one customer we could sell to. By that I mean country. And now that we can deliver crude oil from Alberta to ships in Vancouver that can take it anywhere in the world, we'll have other alternative markets if the price that's on offer from the Americans is too low. So that's actually a great thing, even though it took $34 billion to build the pipeline.
Victor, what a comprehensive report. We thank you very much.
Timmy, you're very welcome. I'll talk to you again.
My guest has been Victor Adair, recently retired from the brokerage business, but still very active in the markets. Check out his website, Richter.Interest. He was speaking to us from beautiful Parksville on Vancouver Island. Coming up, Rick Ackerman, next on This Week in Money.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. Always consult your investment professional before making any investment decision. This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is Rick Ackerman, editor of the newsletter Rick's Picks. His website, rickackerman.com, is speaking to us from the road somewhere in the eastern United States. Where are you right now?
Well, I'm in beautiful, I'm not sure if it's downtown, uptown, or Center City, Draper, Virginia. And I went to school at University of Virginia, and this is a place I've never heard of. I'm on my way up to Reston to get together with some college buddies.
Well, so that's a worthy road trip then.
For sure.
Rick, this week the Fed left interest rates unchanged at a 23-year high, citing lack of further progress on inflation. Do you think we're more likely to see lower rates or higher rates when the Fed finally does make a move?
I have to confess, Jim, that even expressing a concern over that has become It's almost too stupid to think about. And I say that because we came into 2024 with expectations of easing perhaps 5 or 6 times, meaning 150 to 200 basis points. And of course, we got nothing. And of course, up to that point, going back 5, 10, 15, 20 years, nothing could have been more disappointing to Wall Street than learning that we weren't on a path toward easing. So the market not only took that in stride, it continued to rally. It's in almost a spooky, crazy rally now. And so we've gone through this period so far, January, February, March, April, where the market showed itself to be completely inured to any concern at all about interest rates. And now we're back to the old criminology, splitting hairs about the penumbra of the shadow of the penumbra, what it all means. So I'm going to say I don't care. The market's going to continue in its psychotic way higher, but with, at least where I'm concerned, the limitation of something we've talked about in Microsoft, the price $430.58, which is still holding up as the high after 6 weeks.
Are the higher interest rates we've seen so far showing up in the economy and especially housing?
For sure. It's absolutely crippling. You've got mortgage rates above 7% again. And no matter how optimistic you are about real estate prices, it's hard to come in and finance a place at 30 years, 7%. You have to have wildly bullish expectations on real estate, and I think it's kind of hard to come to that right now, given the at best lackluster experience in residential in recent years, other than let's say the COVID era, which is kind of worn off.
Does it look like the stock markets have completed a correction here, or are they likely headed lower?
Well, I'm tentatively decided on this being a bear market. And many months ago, we talked about a target that I had in Microsoft. It was $430.58. The stock made a top 24 cents above that at 430.82. And this was a target that came from my weekly charts. And the logic was that if Microsoft, probably the premier company of this age, is topping, then so is the market. So I'm going on the assumption that we have a major top in, and it's in a rounding process. But I'm open to the possibility that maybe NVIDIA will tell the final story. I think NVIDIA is closely comparable to RCA, which led the stock buying mania of the late 1920s. So when I look at NVIDIA, in order to make the top that RCA made back in 1929, NVIDIA would have to rally from the recent low from the last couple of weeks to marginally above its previous high. So I'm not expecting that necessarily, but I'm prepared for it, and I think that would be a proper hook for it would suck everybody in, because you'd find that the bulls would become wildly bullish again, and the bears would be scrambling, panicking to cover short positions. So we'd have enormous buying power, but perhaps very short-lived.
The U.S. dollar continues to show strength. Do you think the greenback strength will continue?
Over the very long term, I do. I'm a deflationist right to the core, and of course that depends on a strong dollar. I don't think we're in that final phase, though, where the dollar is subject to a short squeeze that pushes it to outrageous levels that will essentially cause everybody who owes money in dollars, meaning the whole world, to have their financial edifice implode. That would be kind of the sounding of the trumpets where deflation is concerned. But I don't think we're there yet, and the dollar has held up pretty well, really, in the face of what we see as inflation. But it's an unusual kind of inflation that's more in consumer goods and services rather than in the for reasons of the monetary blowout we had during the COVID era. So we're still kind of feeling the after effects in terms of consumer inflation of enormous fiscal and credit stimulus for a couple of years. But even now, I guess you could say Powell has put the screws to Congress. We're not going to be quite the spending like a drunken sailor. You're going to find born-again concern in Congress over budget deficits. So we're, let's say, on the downslope now of fiscal stimulus.
Gold has broken out to new highs, but isn't continuing to move higher. Your thoughts on gold?
Well, I think we're somewhat comparable to when in the early 1970s, Nixon took us off the gold standard. You know, there was no mistaking the bullishness of that for gold because it basically freed the central banks from any constraints where printing money was concerned. And we're in a similar environment now where really at the instigation and direction of Putin, the markets are sort of reorganizing themselves, and by markets I mean primarily the crude oil market and certain other commodities. So it's being restructured somewhat so that the producers, main energy producers, namely, Iran is certainly among them, but Russia, the supplier of energy to Europe, they're coming off a dollar standard. And I've always thought that we could never put oil on a hard money basis. If the whole world had to pay in the hardest money of all, namely gold, for oil, that it would deflate, that it would crush demand for crude. But I think you have an interim period where there'll still be a lot of crude bought while the global economy is still functioning more or less, I use the word smoothly, advisedly, but I think ultimately demanding gold as payment for crude is going to put a damper on it, and if that occurs when the world is in the throes of a downturn, an economic downturn, it could undo all the painstaking work that Putin has done to build a coalition that weaned the oil producers off dollar dependency. So we've got a lot of things to play out there, but the implications for gold are bullish regardless. You know, there's clearly a move to shift the markets. The gold markets as well are changing. Gold is being traded now in greater volume in places outside of the usual crooked rigged carnival games of Zurich, Hong Kong, London, and Chicago. So to the extent that gold is finally finding honest places to trade, it's going to be harder for the U.S. in its long-time conspiracy with the bullion bankers to suppress the price of gold by making gold loans very easy to all the players. So that's another thing that will be bullish for gold. But I think when you lump a bunch of things together and you throw in the inflation we're experiencing now, gold is a complete no-brainer. So I think that the big move has really only just begun.
Is it a smart move by Walmart and Costco to offer gold bars or gold slivers or whatever, wafers to customers? Gold has gone retail.
I was unaware of that, but, you know, how can they lose? They're going to build trust with people that are, with buyers, with consumers that are more and more looking for companies that do business in ways they can trust. And, of course, nothing has more integrity than doing business in gold.
Yeah, so while you're stocking up on cheap socks and underwear at Walmart, you can also walk away with gold. Silver is close to half of its all-time high. I still remember the Hunt brothers in the late 70s when gold or silver went up to like $50 an ounce or so. What do you see ahead for silver?
That'll happen again. I think the current target that I've hung out basis the June contract, and it may not get there by June, but I think we're looking at, for starters, around $48 an ounce. But silver's also got some catching up to do with gold. And I think that later in the bullion bull market that's developing now, silver will probably be the higher beta of the two.
Copper's been showing strength. What is this strength signaling?
Well, I think it's a lot of it is kind of the uncertainties of the EV, electric vehicle market. You know, there was a time when copper was in a wallow because ostensibly the whole world wasn't going to, the third world was not going to have to put up telephone wires, that all telecommunication would be via satellite. But of course, copper, we found other uses for copper, and it's certainly the EVs are metal heavy. So I don't know. The story that's driving copper and EVs is somewhat volatile. You know, EVs are having a bad year because we're at a part of the cycle in EV ownership where people are discovering, that cold winters are kind of tough to get through if you've got an EV, and especially if you do some highway driving. And number two, the cost of disposing of the spent EV batteries turns out to be pretty high. The resale values of these cars has become a crushing concern because the repairs are so expensive that when you get what used to be just a minor front ender, the repair was not too expensive, but we're finding that the insurance companies are totaling some of these EVs if there's any battery damage at all. And it's going to take a while before the mechanics get a handle on EV battery repairs where they can do something other than just discard the whole automobile and instead just fix the battery. And it's not so simple as just having the right tool set. You need some knowledge to fix the battery so that you don't get electrocuted or create an explosion.
Well, the amount of copper used for one electric vehicle is absolutely astounding. It uses 277% more copper than your regular vehicle, something like 83 kilos or 183 pounds of copper.
Interesting figure.
Yeah. Crude oil has pulled back a bit. Are we likely to see $100 crude ahead or this year?
Yes, we are. And, Tom Longo in his Gold, Goats, and Guns newsletter makes some interesting points about that. You know, he says that the arrangement that has obtained for all of our lives between oil producers and buyers is the buyers up to relatively recently have been able to say, you know, we've got the money. How you get the commodity out of the ground and get it to us is your problem. But now, essentially, with the effort that Putin has made to build a coalition of oil producers, the equation has changed so that we're getting into the era of the commodity producers saying, we've got the oil, you know, the money's your problem. So they're raising the price effectively by taking the price of oil out of dollars, putting it in other things, and that effectively does raise the price. I don't know. It's going to be very disruptive for this world, but it'll be bullish for the price of oil. And disruptive though, in the sense that the whole world, there's a strong consensus that the dollar is the greatest way ever devised to pay for oil for a couple reasons. You know, number one, it's an infinite supply, and it's universally fungible. But that's changing a little bit. But up till now, we've enjoyed the convenience. It's sort of equivalent to seigniorage, but not with the currency, but with commodities. And so we're being inconvenienced really by being asked to pay for this increasingly precious commodity, crude oil, natural gas, with harder money. And why did the producers accept an arrangement to begin with where they knew they were being paid in crap money, and I'm talking about dollars? You know, the dollar is not really money. The dollar, every single bill you pull out of your wallet is fundamentally an IOU. It's just a debt instrument. So the producers, Saudi Arabians and Brazil and Venezuela and all the others, have been happy to accept snide, counterfeit money because they took enough of it. It's pretty obvious that they charged high enough prices that it didn't leave any Saudi prince lacking for a fleet of Lamborghinis. So that's another question. The producers have finally turned the tide. And again, Tom Longo makes a nice case that it's really been at the instigation and with the tactical brilliance of Putin behind it.
Yeah, an interesting recession gauge. I remember somebody saying, "Oh, I know there's a recession on." I said, "Why?" He said, "I was at Heathrow Airport and a Saudi prince, instead of lowering 3 gold-covered Rolls Royces from his 747, only lowered 1, and he only brought 11 of his 57 wives." That's a recession indicator.
Yeah, that's tough times there in Riyadh.
Yeah.
Speaking of recession, you know, we get this the impression, at least where Fed monetary policy is concerned, that the economy is going gangbusters, and yet consumer sentiment is getting worse and worse and worse. And we know in our lives that we're not in any kind of boom. Everybody's working hard to kind of stay in place, and it's not like it's easy to make money, and everything is costing more. Especially, you know, the important things, putting your kid through college or whatever, or trade school now. but there's such a dissonance there, cognitive dissonance between the official statistics that the economy is just booming and the general impression that you and I get anecdotally that things are not quite so good out there in the real world.
Sure. I mean, they always say 200,000 jobs were created, but what kind of jobs? They're Uber drivers. They're people cleaning hotel toilets on weekends to supplement their regular income to survive through inflation. Those aren't the kind of jobs you really want to create, are they?
Absolutely. You know, I mean, no distinction. When the market does its usual histrionics based on the job figures, it doesn't give a damn what the quality of the jobs are and the quality of the overall economy that's generating those jobs. But you know, and I know, just in the course of our lives and in the real world anecdotes we hear, that the jobs are not, the good jobs are not plentiful, and where they exist, they're being filled by foreigners anyway, people who go through the engineering programs and things like that. So we're turning out a lot of sociology majors, psych majors, art history, and it's getting harder for our economy, the U.S. economy, to absorb all those non-productive workers. So where we get growth at all, it's in areas like government, which is entirely non-productive sector of the economy, and in healthcare, where let's say costs are not so well controlled.
Does natural gas look like it's bottomed?
I should think so. I mean, Europe is always going to. I think their supply problem will become more and more critical. The supply is not so fungible as dollars, but the U.S. has plenty of liquid natural gas to ship around the world. But even there, you know, there are other elements that will create scarcity. Number one, or mainly, it's the shipping problem, and this is another wrinkle for the world energy market that the insurers are making it quite a bit more costly to ship crude and liquid natural gas, and that cost is going to fall not on the producers but on the buyers. So I think the market for liquid natural gas is going to continue to tighten and drive the price higher.
Now, something not heavily publicized, Israel, Egypt, Saudi Arabia, they're working on a land route in the Middle East so that they don't have to rely on the Strait of Hormuz and the Red Sea to transport both energy and durable goods through there, so that if the Houthi rebels or whoever put up another blockade and force ships to move elsewhere, they are now working on a land route so they don't have to worry about ships. And they find land routes are much easier to defend as well.
Much easier? I don't believe that.
Yeah.
I don't believe that's true in the age of drones and precision missiles. You know, the Houthis aren't even using their best technology to take out these tankers, and it's amazing that the world has allowed it to happen. You know, you go back to when Jefferson took on the Barbary Coast pirates, it didn't take long to get rid of them. But for whatever reason, we're not making that effort. I guess the reason is that any kind of confrontation of that sort, when you go up against the Houthis, you're pushing Iran perhaps to a stress point, because the Houthis are firing Iranian missiles and deploying Iranian drones. So I don't know. I don't think the land bridge strategy is viable as a long-range plan for keeping energy prices down.
Does it look like Bitcoin has put in a top?
No, I mean, I never tire of saying that Bitcoin it's an epic fraud, and nobody, I don't care who it is, give me any expert from the Bitcoin world to explain why Bitcoin should be worth anything, and none of them, not a single one, has come up with a good reason. Certainly not the reasons that we tick off to explain why a particular currency is money, why it's worth something. But there's nothing behind Bitcoin, and the only thing behind the original mintage, the Satoshi Bitcoin, is scarcity. And scarcity alone is not a condition to giving something value. So whatever value it gets, and we've talked about this before, I'll concede that Bitcoin should be worth $2 or $3 because the blockchain that creates it is in theory capable of recording a transaction securely, but not so efficiently. You know, it still costs more to do it than you would experience with a credit card. And for that reason, we don't see Bitcoin being used in routine transactions. It's purely a speculative medium. Not purely, but just maybe 99.999%. So Bitcoin is bullshit money, if you pardon the expression. But that doesn't. When I forecast it, I'm simply looking at a chart. The chart, to me, says it's going to at least $80,600, and we'll see what happens then. I've got a couple of Rick's Pick subscribers who have made a ton of money with Bitcoin, and they're very knowledgeable about how to convert it. You know, they're using Bitcoin Wallet, and not necessarily traders. One of my guys has really just kind of stuck with Bitcoin for the whole ride, and he's done well. And one forecaster he follows says 150 grand is where it's going, but I haven't used any pie in the sky forecasts. I take my forecast one target at a time. The current target is $80,663, and we've been as high as I think it was 75 or 76,000. I will say that the correction that has followed that high looks to me to be too involved to project the missile just only marginally higher than the 76,000 high. So to me, it looks like it's consolidating for a shot at 100 grand. But for the time being, I need to see it exceed 80,660 before I take on the next target.
Does debt matter anymore?
It will, but and it matters in the sense that it will matter gravely at some point in the future. That's inevitable. And I say that it will play out in a deflationary way, meaning we're not going to have some hyperinflation that turns all the debtors into big winners. So it's like you've got a $400,000 mortgage, and hyperinflation, in theory, gives you the ability to open your wallet, hand your mortgage lender $400,000 bills and say, well, that settles us, doesn't it? I don't think debtors, particularly Joe Sixpack, the homeowner, is ever going to enjoy that kind of emancipation. So debt will be reckoned discharged in a deflationary way, and of course you got the whole other not a different scenario really, but there's something that I think David Webb wrote about called the Great Taking, that says that the few are ready to benefit from a financial collapse because laws have been rewritten so that you and I don't really own anything anymore. It's technically owned by some entity that's in debt. It could even be the financing arm of an auto dealer. So that allows the few takers, the ones who are sort of plotting to take down the financial system and wind up with all the spoils, all the collateral, all the assets will trip into their slimy hands.
Rick, how can people subscribe to Rick's Picks?
Just go to Richter.Interest, and up top there's a free trial offer there. Just click on free trial, and you don't even have to leave a credit card number. Just sign up and stick with Rick's Picks. I do offer a guarantee if you take an annual subscription for, I think it's $400, and at the end of the year you haven't made that back, then I'll give you your money back. I do put out a lot of trades informally in the chat room, and I would say, even though past performance is no indicator of future performance, I've got a pretty good track record, a preponderance of winners. So I would encourage anyone to take the free trial offer. You get instant access to a chat room that draws some of the best traders from around the world. And there's another two rooms, a trading room and a coffee house, where a lot of interesting ideas are exchanged.
Rick, thank you so much for being on This Week in Money.
Well, thanks for having me on, Jim. It's always a pleasure, and it's a privilege to connect with your audience.
My guest has been Rick Ackerman, editor of the newsletter Rick's Picks, his website, rickackerman.com. He was speaking to us from somewhere in Virginia. Coming up, Wolf Richter, next on This Week in Money.
Recyclico, making lithium-ion last forever. Recyclico's patented recycling process achieves up to 100% recovery of battery metals from lithium-ion batteries for electric vehicles, including cobalt, lithium, nickel, manganese, and aluminum. Recyclico Battery Materials Incorporated trades on the TSX Venture AMY, on the OTCQB AMYZF, and Frankfurt ID4. For more information, visit recyclicode.com or phone us at 778-574-4444. Recyclico, making lithium-ion last forever.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is Wolf Richter, publisher of wolfstreet.com. He's speaking to us from San Francisco. Wolf, welcome back to This Week in Money.
Thanks for having me back, Jim.
Wolf, the Fed had its policy meeting this week, and now suddenly there's lots of talk about not rate cuts, but rate hikes. What's going on? What could the Fed be seeing?
Yeah, so Fed Chair Powell was very unenthusiastic about talking about rate hikes. I mean, that was clear. But what we've had, but there were a lot of questions from reporters about that because the attitude has completely changed. We have had 3 months of really bad inflation data, and that came after a few months in late last year of data that showed that beneath the surface inflation was starting to heat up again, and that came to the surface in the first quarter of this year and across the board. So this was the consumer price index. It was the index that the Fed follows, the PCE price index. It was the producer price index. It was the labor cost indices. It was all over the place. And so this shows that in the United States, at least, inflation is starting to bubble up again, that there were some special things that came together in 2023 that caused inflation rates to drop dramatically. So that was plunges in energy prices and just a plunge in durable goods prices, and a drop in service prices to some extent. And but not far enough, and so now a lot of this stuff outside of energy, a lot of this stuff has turned around. Services remains hot. It got hotter. Non-housing inflation is getting hotter. Housing inflation has stayed the same at hot levels, and durable goods prices have stopped dropping. They're starting to rise again. So this is now clear that we have an issue with inflation, and that it's just not going to vanish on its own, and it's going to need probably some fairly consistent treatment for quite a while. So higher for longer, meaning higher inflation for longer, higher interest rates for longer. And so the question arises, what should the Fed do about these inflation measures? And so right now, the rate cuts have essentially vanished from the horizon, and they're really not being seriously discussed anymore. It's just really how long should the Fed hang on to these current policy rates at 5.5% at the top end, and if inflation continues to rise, and so that was the issue with the policy meeting. If inflation continues to rise, the Fed will hike rates. And so the Fed doesn't project a continuing increase in inflation. So it is projecting that this was sort of a temporary increase, and that inflation rates will start tapering off again later this year. And so that if it holds rates steady, this will somehow balance out. And that may be the case. Now, this is maybe what we're getting. That increase in inflation that we saw in the first quarter may be tapering off. It is possible. It is really impossible to predict inflation in that sense. And so this may be a scenario that plays out, that this inflation will gradually go back down again, and the Fed doesn't really have to do much more except to sit on these higher interest rates and watch them work. The other scenario is that what we've seen in the first 3 months of this year will continue to go on, and that inflation rates will continue to tick higher in their sort of uneven up and down manner, and that at some point it will become clear, especially when they start rising above the Fed's policy rates, that the Fed may have to hike rates again. And so that would be the scenario that Powell outlined as well, which is not the base case that the Fed is seeing, but it's a possibility, and he said that we may need to hike rates more if inflation continues to rise, and so those are the conditions. And if we get increasing inflation rates over the rest of the year, there will probably be a rate hike. And nobody really wants to hike interest rates just right before an election. We have our presidential election coming up, so keeping it steady would be the most neutral thing to do. But there is a meeting after the election, so the election is in November. We have a December Fed meeting, and so that could be a logical meeting for the first rate hike if there is one. And so inflation really has changed direction here in the United States, and that's not a good thing, and it could be a 3-month blip, but the underlying data show us that it's probably not a 3-month blip, that it's probably something that's going to have to be dealt with, and finally the Fed has responded to that, and the reporters have finally responded to that. The prior two meetings, it was all about rate cuts, how many and when will they start, will we get one next meeting, that kind of stuff. And now it's about rate hikes. When are we going to get a rate hike? And there's a completely U-turn here, and it will have to impact, inflation will have to impact the Fed's policies. And if inflation disappears, the rate cuts will eventually materialize. And if inflation resurges, we're going to get some rate cuts. Some rate hikes.
Are other central banks likely to follow whatever the Fed does?
Well, the assumption was that the Fed would cut rates, so the other major central banks have sort of lined up rate cuts as well, and that was before the recent surge in inflation here. The ECB has pretty much locked in a rate cut in June. The Bank of Canada has been talking about cutting rates, but obviously it's kind of joined at the hip, the Fed. So it doesn't really want to cut rates and then the Fed not cutting rates. So that would be problematic in terms of the currency. Currencies are really responding to those divergences that you can see here. And in terms of Mexico, the Bank of Mexico has been very smart about this whole scenario. They've had a fairly large bout of inflation too, but they front ran the Fed by about a year. They came in with very big rate hikes very quickly, a year ahead of the Fed, and got into the double digits there with the policy rates up to over 11%. Their inflation rates were not far higher than the rates in the United States and in the similar category. So the policy rates were way above inflation rates. And as a consequence, the peso has done extremely well against the US dollar. Brazil has followed a similar policy with the same effect. And those countries have managed to keep their currencies in a very good shape in relationship to the dollar, whereas some other countries, especially Japan, has failed to do that, and the Japanese yen has collapsed against the US dollar. The Bank of Japan has finally raised its policy rates from the negative by 10 basis points to 0%. And so the yen continues to fall against the dollar because that's now where this divergence gets carried out, is in the currency. And so now the authorities in Japan are trying to prop up the yen with market interventions, and that's a very expensive thing to do. They're having to sell dollars and dollar instruments, and they're having to buy yen. And so that's a very costly way. But the Bank of Japan has been hoping for 6 rate cuts, I guess, this year in the United States. And so they've decided they're going to outweight these rate hikes, and they're just going to wait till these other central banks come back down. And so the United States is not coming back down. And so the Bank of Japan's got a huge problem on its hands. And that divergence there is really hitting the yen hard, and it's making it difficult for Japanese companies to expand overseas, to invest overseas. It's making the yen a very weak currency. The yen has collapsed 50% since this Abenomics QE program started in 2012. It's 30% of that collapse came in the last 2 years. So that is a problem with the divergence, and eventually the Bank of Japan will have to do something about its policy rates, and it's still doing QE too. I mean, all the other central banks are doing QT. They're taking liquidity out of the markets, and Japan is still adding to it, even though at a slower rate. So there's a real policy mismatch that is hitting the yen very hard, and it's not sustainable. And eventually the Bank of Japan will have to change course. He made a colossal error in thinking that the United States would cut policy rates by 6 times this year, and that's probably what the bet was, and a bunch more times next year. And they just figured we're going to wait, and that has turned out to be a major problem. So other central banks are having to deal with what the Fed does because of the international use of the dollar, and they don't want their currency to really plunge against the dollar. The euro is a very strong currency, so the movements are not that huge against the dollar. So the euro has come up against the dollar when the ECB started hiking rates and doing QT massively. It dropped against the dollar before then, but not substantially. I mean, it was a pretty good drop, but it wasn't like Japan's, and so now it's kind of back where it was. But in Japan's case, it's a real problem. So other central banks can't completely ignore what the Fed is doing. They're having to manage their way around this. The Bank of Canada, if it cuts rates, will probably be very careful. It will try to delay them, and it will minimize them, and it will try to not get too far ahead of the Fed, because that would cause problems with the Canadian dollar against the U.S. dollar.
Years ago, debt bubbles were a concern. Debt bubbles are even bigger now. Is it possible there will be no day of reckoning and debt bubbles can just continue to grow?
Yeah, that's the hope, isn't it? That doesn't matter somehow, and that it can continue to grow. The situation we have in the United States is that consumers are actually in fairly good shape. So consumer debt in terms of disposable income is at relatively historically low levels, and it's very manageable. Obviously, there's some people that are in over their heads, but so far in terms of income, they're really in pretty good shape. The problem we have is in business debt and obviously in the federal government debt. And so the catastrophe that our fiscal situation is it's just not sustainable. That is a problem. We have a budget deficit that is just huge, and it's huge in a booming economy, and that's the real problem. If you're going to get a recession, it will completely blow out. We already have a huge debt deficit, just keeps piling on new debt. It is just completely ridiculous how this has turned out. And so that's the number one problem we have. In general, sovereign debt, where the sovereign controls the currency, it doesn't provide a credit risk, but it's an issue with inflation and with the currency. So we're seeing that part of that's in part why inflation is resurging in the United States, because of the deficit spending by the federal government, and that's very stimulative. And so that's how government debt bubbles get resolved, is with inflation. And so they're not credit events generally, but they're inflation events. And I think that's what we're facing in the United States. Businesses also have a very large debt load. Now, we have plenty of businesses that are sitting on lots of cash and don't have a lot of debt, but there are lots and lots of businesses that are below investment grade, they're junk rated, they have negative cash flows, they've got lots of debt, and that's where the damage will occur in this space. And there'll be more bankruptcies, there'll be more restructuring. Right now, we're far from that, because financial conditions are still very loose. And it's still very easy to borrow for these companies, because there's still all this liquidity floating around. So far, we really haven't seen a lot of stress in that area. But that's where the corporate debt problems are going to play out, is in the junk rated area, and that's leveraged loans, and it's junk bonds, and it's private debt. Private debt has surged, and so that's the third factor in there. That it's sort of opaque, and we don't really know how much there's out there. We know how much in leveraged loans are out there. We know, so these are syndicated loans that are spread among investors, not banks, and we know traded like bonds are traded, and we know how many junk bonds are out there, and they're investor held and not banks. And the private loan market is also investor held, not by the banks, but it's opaque. We don't really know how much there is, but it's booming, and all that we'll see some pretty significant losses when this corporate debt bubble turns down.
What's the latest on the housing market in the U.S.?
Well, so we had a little bit of what I call a rate cut mania, and that started in November. and it went through about mid-February. And this was based on the assumption, now obviated by events, that the Fed would cut rates 6 times in 2024, and that mortgage rates would therefore plunge. And so mortgage rates based on the markets actually dropped a bunch. They went from 7.5%, our standard 30-year fixed mortgage went from 7.5% to 6.5% in November last year, in December. And so that caused then housing to respond. Sales volume was still extremely low, and it's down about 30% because small uptick in sales volume, but not much. But it caused an increase in prices, and we've seen that in some markets, the prices have plunged a bunch, down a lot, and so we've had several months of increases there, and overall, it looks like house prices are kind of back where they were now. So across the country in June 2022, so that was the prior peak, and so this rate cut mania has had this impact, and we can clearly see it in the numbers. Now, rate cut mania died. It died in February 2000. In February this year, in about February 13th this year, when we got the CPI report, the January CPI report that showed that inflation was resurging, and that was the first one of the bad inflation reports, and then we got a whole bunch more following. So rate cut mania has vanished. The markets are no longer really pricing in any major rate cuts for 2024. Now we've got this talk of rate hikes. Mortgage rates are back over 7%. And the housing is dealing with that situation year over year. The listing prices are already below where they were a year ago, so this started to unwind. But that's what we've seen 3 months ago, and so now we're going back to this thing of mortgages being in the 7.5% range, and with prices having to deal with it. We're seeing a lot more inventory show up. New listings are up. Active listings have grown up substantially. They're at multi-year highs. Sellers are cutting their prices. New home prices have come down a whole bunch, and home builders, they're the pros, and so they have cut their prices. They're buying down mortgage rates, and they're competing heavily and aggressively with home sellers, so with homeowners that want to sell their homes, and so that's putting some pressures on existing home prices. So you can buy a new home for a smaller payment than an equivalent home that's already existing. So yeah, these are the changes we're now looking at. It's a tough environment in the housing market now, and if you own a house that you're wanting to sell, you're competing with a home builder that's selling a new house and that's buying down the mortgage rates and it's got prices, and the payment's going to be lower than what your buyer is going to have to pay. So it's that kind of picture. I think the market will have to deal with this with these higher mortgage rates in terms of bringing prices down, because those higher mortgage rates are just not feasible at these current prices. So prices will have to come down to get housing volume of existing sales volume of existing houses to move. So if people want to sell their house, they have to price it right. They have to price it aggressively, and I think we're going to see that phase.
What's the latest on the most splendid housing bubbles in Canada?
Well, Canada is a little ahead of the United States, and in terms of the housing market, obviously your mortgage rates are different than ours. We have our 30-year fixed rate mortgage, and that means that the payment stays the same for 30 years until you sell the house and get a new mortgage. And that's not the case in Canada. So in terms of homeowners that own the home and that don't intend to move, nothing changes in the United States. Their payment stays the same, so there's no pressure on them. The only thing that happens is they don't sell the home. They're not buying a home. They're not selling out of the market. They're sitting on their 3% mortgage, and so that end of the market has vanished. They're gone as buyers, they're gone as sellers, and they're just sitting there, and it's the home buyers that are struggling with these higher mortgage rates. In Canada, it's different. You have mortgages that are where the rates are adjustable. They adjust in different terms. So when mortgage rates go up, homeowners that own homes and have had mortgages for a while, they're seeing higher payments. And so that has impacted the market much more quickly than it has in the United States. And so the overall home price index by the Canadian Real Estate Association, so they have dropped, and the index is now down 14% from 2 years ago, from the peak in March 2022. So, and they're back where the index had been in September 2021. So these are pretty big moves. Of course, home prices have shot up so far that when you look at the chart, it really only took out like 1/3 of that huge increase that home prices had between 2020 and mid-2000 or early 2022. So in that very short time period, prices jumped so much that the decline since March 2022 has taken off only about 1/3 of that spike. And so home prices remain very, very high in Canada. And in some cities, obviously, prices are still going up, like in Calgary. There's just no stopping there, it seems. In others, like in Toronto, prices have taken a very big hit. And, condos in the greater Toronto area, that's a big part of the market. And they have dropped to the lowest in October 2021. So they have carved out a new low for the last few months, each month, and in multi-year low there. And condos are very big in Toronto, and that market is in serious trouble now. And they're down. They've unwound maybe about close to half of the spike during the pandemic, and they're still very expensive. And they jumped in prices before, so it's still a very, very expensive thing to buy. But they've come down a bunch, and it doesn't look like that they're going to benefit from any uptick.
How are new vehicles selling?
So when we look at new vehicle sales right now in the United States, we're looking at a rate of about 15.5 million a year total. So that's retail and fleet, and that's up a little bit from a year ago. But when we look at that, we need to keep in mind that in the United States, our peak sales rates were around 17.5 million vehicles per year, and that occurred in the year 2000, so about 24 years ago. And then we had this big trough during the financial crisis after that. And then it finally recovered. By 2016, we were back to that range, that 17.5 million, and then tapered off. And then we had the big trough during the pandemic. So 17.5 million, that's kind of like the glass ceiling in the U.S. auto industry. And we're at 15.5 million so far tracking this year. And so that's up from a year ago, and it's up a lot from 2 years ago, but it's still way below that glass ceiling that we've had. And so the industry is kind of happy with that, because cars are too expensive. They have moved out of mainstream, it seems like, new vehicles. And with average selling price of a new vehicle now around $46,000. And so a lot of people can't afford those vehicles anymore. They're buying used. There's lots of used vehicles on the market, so that's a good option. And some manufacturers start cutting prices, such as Tesla. That's a good thing. We need to see that. We need to have big price cuts across the board in new vehicles. They've just gotten too expensive, and that's not really happening. And Tesla's trying to get everybody else, it seems, to cut, but they're not that slow in following, and so prices are staying high. And sales volume are low, relatively speaking, compared to what they were many years ago. Retail sales this year are up a little bit compared to last year, but fleet sales are down. Fleet sales spiked last year after the pandemic. The pandemic shut down essentially fleet sales because there are the shortages and semiconductor shortages, which caused a whole bunch of production cutbacks among automakers, and so they started building the most expensive models and big equipment packages because they couldn't build as many cars, so they tried to maximize the dollar revenues by building expensive vehicles and selling them to the retail channel, and so they got more money for them, and the rental car companies just got a trickle. And so they had these shortages in the fleets, and they're big buyers. They're huge buyers. They generally buy close to 3 million, sometimes over 3 million vehicles a year in the United States. That's a lot. And so during the pandemic, they had to keep the units in the fleet longer because they couldn't replace them. They ended up buying used vehicles in the wholesale market. And so last year, when the manufacturers started building again in large quantity, the rental car companies started ordering in massive amounts. And so against this increase in fleet sales last year, our fleet sales this year are a little bit lower. And that makes sense as they're starting to normalize the inventories. Retail sales have been pretty good, and I mean, they're nothing to write home about in terms of the long view, because we're still 2 million units below the glass ceiling, but they're better than they've been in several years. So they're doing pretty well. You know, especially given the ridiculous pricing that new vehicles are still commanding here. They're just way too high. Prices will have to come down.
What's going on in the used vehicle market?
Yeah, so there we're seeing the price cuts that we're not seeing in new vehicles. So used vehicles, of course, the prices have jumped 55% or so in 2020, 2021. And that price spike is now getting unwound. They have come down very hard. On the wholesale side, prices are down about 20% from the peak in early 2022. On the retail side, prices are down maybe around 15% from the peak. And so that's happening, and that appears to continue. And they're still very expensive. Used vehicles are still outrageously high, but they are coming down. They have come down, and it's an essential function of volume. People have gotten tired of overpaying for used vehicles. And yeah, a motor vehicle is kind of a discretionary purchase unless you total your vehicle and you have to buy something. But for most people, they can drive the vehicle for another year or two or 5 years if they need to. And so they don't really have to buy something right now. They can delay that purchase. And the used car market is seeing some of that. The volume has tapered off. And so demand has to be created by lowering prices. And there's adequate inventories. And the fleets are starting to sell into the used market again. So that's starting to happen again. And so I think there will be plenty of supply in the used vehicle market, and not a lot of red hot demand in these at these prices. So I think there will be more price declines as this year. Maybe not as drastic as we've seen, but I think there'll be some more declines.
Are the high prices of fuel causing more and more people to buy electric vehicles?
Well, I think there was some of that when we had these very expensive gas prices in 2021 and 2022. That's a real motivation, especially in a place like California where gasoline prices are very high. And they went over $6 a gallon here, so I don't know what that would be in Canadian dollars in liters. But that for us, that's a lot. And it made a lot of sense to switch to something that wasn't using gasoline, and people did. There was an incentive to switch. It improved the comparison in operating expenses between EVs and internal combustion engine vehicles. Now gasoline prices have come down a lot from that, so it's less of an incentive. They're much lower than they were. They've stopped dropping, but they've come up a little bit, but they're down quite a bit. So I don't think it's as much of a hot topic anymore as it was, and it's not really that big of an incentive anymore to buy an EV because you're kind of used to these gas prices that we now have, and so it's sort of not the kind of issue anymore that it was.
Wolf, where's the best place for people to follow you?
Wolfstreet.com. It's free. There's no paywall. It's about business, finance, and money. No politics. And we have a vibrant and largely well-behaved comment section.
Wolf, thank you so much for being on This Week in Money.
Thank you, Jim.
My guest was Wolf Richter, publisher of wolfstreet.com. He was speaking to us from San Francisco. And that wraps up our show for this week. We'd like to thank our guests, Victor Adair, Rick Ackerman, and Wolf Richter. And thank you for listening. If you have any questions for the show or for our guests, you can send them to info@housestreet.com. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at TalkDigitalNetwork.com. This Week in Money is a production of House Street Media Incorporated. Executive producer is Tom Allen.